This interview is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome to Cambridge House Live. I'm Vanessa Collette here at the 11th Annual Silver Summit in Spokane, Washington. I'm joined by Peter Spina, founder and president of GoldSeek and SilverSeek.com. Welcome, Peter. Great to have you here with us.
It's great to be back.
Peter, let's start right out by talking about Janet Yellen's appointment to the Fed. What do you make of it?
Well, I think her nomination is a very positive development for those who believe in ongoing quantitative easing, and that has been the ongoing policy of the Federal Reserve through Bernanke. And with her nomination and probably her eventual appointment, we'll continue to see this ongoing printing programs continue. So she'll provide a good rubber stamp to the ongoing money printing programs.
Now, being Ben Bernanke's deputy, is she going to be able to do anything differently? Are we going to see any tapering or even more aggressive easing?
Well, I think there's different ways that you can influence monetary policy. Printing is one way, easing up some credit restrictions, maybe even guaranteeing some various loan or credit programs, ways to get more credit out into the system. So those are other ways that she may come in and change things, but she's made it very clear that one of the main things that she is looking for is increase employment through printing more money. I don't know how that is really a free market way of thinking, but to print money for jobs, we are seeing a very weak jobs numbers recently. So most likely she's going to be printing a lot more money to get to that target that she's looking for.
And how is all this easing that you're speaking about going to affect the U.S. dollar?
Well, it all comes down to supply and demand. So the more units of whatever it is, whether it's dollars or euros, you create, the more units it'll take to buy an ounce of gold or silver or a barrel of oil or whatnot. So specifically with gold and silver as a monetary metal, the attribute is starting to become, the gold and silver's return into the system as money is going to continue to benefit from ongoing monetary easing and printing. So with I think we're really in a key point right now because there's been a lot of talk about tapering. There's been a lot of belief that they will that they may have tapered last meeting or this upcoming meeting or the next upcoming ones. But now with the data looking weak again and not a lot of confidence in the economy being able to handle much of any sort of pullback on the tapering front, there's going to be a really big move in sentiment and shift in attitude into what gold and silver should be in someone's portfolio. There's been so much selling of gold by the Western institutions, by Western investors. We've had about 10 million ounces of gold leave the ETF, and a lot of that's shifted over into Asia. As has been the process for the last couple decades, all that wealth is moving overseas. But now, with the Westerners now stopping selling their gold and silver positions, mostly the gold positions, if they're going to start coming back into the market as buyers, you're going to see a lot of difficulty on supply side. So that could become a very bullish thing. And when we're in a very extreme negative state right now in the precious metals market in the West right now. So I think we're going to see a big shift in psychology in the markets, in the gold and silver markets soon.
Peter, what options do you think the U.S. government has left at this point?
Well, they can continue to use this freshly printed money to run large deficits and try to be this in this Keynesian mentality of being this conduit of trying to expand the economy through these various programs, government programs. But I think there's something that is starting to come to the forefront, which is foreigners are not willing to finance our debt as aggressively. And recently we saw about $130-some billion of outflows of treasuries in the last, I think through July's data. So now we have China, Japan, Russia was a big seller of treasuries. And we're issuing more and more debt. So now the Fed is kind of in a position where they may actually have to increase quantitative easing to make up for this increased supply of treasuries and this need to actually create more money to put into the system by issuing more debt. So, there's this change now in attitude and what's happening next. If we may not really taper, we may actually have to be increasing the quantitative easing programs.
So how does this ultimately affect gold and silver?
Well, again, the main thing here is the belief that we were entering this quote-unquote escape velocity, that the economy would benefit from all this printing, that all this money that's being fed into the stock market, the real estate market is another conduit to all this money printing, that would create enough growth in the economy that they could taper, and that would generate enough growth and tax revenue, so on, so that they wouldn't have to have such easy credit policies. So now that that's not going to really happen, that's not happening, and you're looking at potentially even more money printing and having these easy credit standards go on for years and years, and just kind of like Japan, where you just can't get out of this cycle. We're looking, Main Street's going to start looking at gold and silver a lot differently again. So that's very bullish for the gold and silver market. But again, it's a psychology of Main Street and Wall Street at this time is still quite negative. They still haven't figured out, but they're just about, I think, to figure out that things aren't the way they thought they were, and gold and silver as money is going to come back to the forefront.
Let's talk specifically about some of your projections. You're the author of a weekly newsletter, The Gold Forecaster, Silver Forecaster. Where do you see silver going in the short term and longer term?
Well, silver is working through this very extreme negative, pessimist, negative state. I mean, the market is kind of, silver market is kind of two extremes. We had silver hit $50, and it overshot itself to the upside in the short term there, and now the opposites happen. We've come down to even below $20 an ounce, which is an excellent opportunity, but the negative sentiment and the attitude towards silver right now is really amazing. From a contrarian standpoint, this is an amazing, you can't get much more negative than we are right now. So in the short term, I think we're going to be lifting off this extreme negative state, and we'll kind of have to see what happens in the next Fed meetings. But if there's no tapering and coming up the next couple of meetings, I think that will help to benefit the monetary metals. Silver is starting to move back up to the mid-20s. I think that will probably see 24, 26 as kind of a resistance area technically, but we can see silver kind of hover around that area, consolidate for some months, but eventually we'll see it go to the upper 20s, around 30. Mid to long term, I expect fully that will retest $50 an ounce and move much higher in the coming years.
And what about gold?
Gold as well. Gold is going to help lead silver, and once gold really starts to move, as it did on the downside, silver moves in much larger degrees to what gold is doing. So on the upside, silver will move a lot faster. Right now we're around a 60-to-1 ratio, so 60 ounces of silver buy you 1 ounce of gold. That is a lot higher than we have been in the last few years. But if you look at how much gold and silver there are in the earth, it's about a 12-to-1 ratio. And historically, it's been around a 12 to, I think, 16 ratio. So it's very likely that we'll return back down to that ratio. So silver will outperform, and it's kind of a leverage way to invest versus gold. So at this 60-65 ratio right now, I think it's a very interesting, exciting time to be switching. Even if you are in gold, maybe you want to move some over to silver at this time.
Peter, how well do you think the silver stocks are going to weather this negative sentiment that you've discussed?
Sure. Well, it depends which stocks you're talking about. If you're looking at the grassroots exploration companies who are always constantly needing to go to the market to finance and raise cash, they are in a very difficult position right now. Those who actually can find capital are going to be issuing money at very low share prices, so they're going to dilute their share structure. And that's not, as an investor, you're going to lose a lot of leverage, and it's not very good time. It's a risky time. When you start looking at more advanced development stage companies, producers, they're trading at very low valuations. They're very attractive valuations right now, and buying some of these companies for 60, 70, 80% of what they were trading at a couple of years ago is quite amazing. So it's a question of timing. You'll never be able to time the top of the market, and you'll never be able to time the bottom of the market. And right now, that's the kind of question. Where is the bottom? Have we hit the bottom here in June? And are we now lifting off of that? Or are we going to have to retest that again? It's a very difficult thing to predict short term, but I would say that if you can accumulate at these levels right now, in the coming years you'll look pretty good.
Peter, the S&P and particularly tech stocks have been hitting new highs. What keeps you from jumping ship and investing in the tech sector?
Well, I think it's kind of a lot of this. There's all these financial bubbles happening, and it's being fed by the Federal Reserve by its easy money policy. So you look at the tech sector, the valuations there are very high, and there's a lot of exciting stories out there and things I would like to invest in if they were a lot lower valuations. But right now it's kind of it's a bit of a bubble mentality, and it's not as extreme as it was in late 90s, but I can't justify buying some of these companies with 200, 300, 400 P ratios when you can buy some miners who are trading at single-digit P ratios.
So fundamentally, what is it that you like about mining stocks?
Well, they have leverage to the price. So a company who's producing silver at a cost of say $15 an ounce, and the price of silver is at $20 an ounce, now they're making $5 an ounce. If silver goes back to 30, their profits increase. It goes up, double, triples there from that level. So the leverage that the miners provide is very enticing, and they should outperform the silver price when it starts moving back up.
We have a question from one of our viewers who is asking if the gold and silver ratio prices are met, the expectations are met, isn't that going to make a lot of electronics and even solar panels unaffordable for the middle class?
Yes, I think what we'll have to see is when this monetary situation plays itself out, this debt problem plays itself out, and we see gold and silver at record highs, it's going to hurt. You're going to see problems in the industrial demand side, especially for silver, but it's going to be overwhelmed by the investment demand. So yes, it may cause those problems, and you'll see some decrease of demand from that side. But again, 100 million, 200 million ounces a year investment demand is peanuts, and there's trillions of dollars floating out there, so it'll overwhelm the loss of industrial demand.
Well, Peter, it was a pleasure having you with us again today, and we hope you enjoy the rest of the show. Thank you.
Great, thanks for having me on.